Hello, and welcome to this video presentation by Birken Road Reports, with continuing coverage of Gulf Island. Our analyst team consists of Brandon Benedetto, Adam Laurie, Alberto O'Nocton, Christopher Reese, and I'm Nicholas Pearls. Our investment research manager and advisor throughout the research process was Jacob Pritikin. Through our industry analysis and forecasting, our group generated a target price of $8 and a rating of market underperform. This means that we expect the stock to perform significantly worse than the general market. Our plan for this presentation is to help you better understand Gulf Island and the analysis we use to determine our 12-month target price and investor rating. We will start with an overview of the company and then take you through our investment summary, which we hope will give you a better idea of Gulf Island's financial position. Finally, we will take you through an analysis of the industry in which Gulf Island competes and detail our methods for our financial forecasts. Gulf Island Fabrication was founded in 1985 and is a provider of custom construction and maintenance services, primarily for the energy industry. Services include fabricating offshore oil and gas platforms, living modules, marine vessels, skids, jackets, and drilling modules. Gulf Island has 5 subsidiary companies, mostly located around Houma, Louisiana. Most recently, they have expanded operations to Corpus Christi, Texas. The company recently moved its headquarters to Houston, Texas. Gulf Island Fabrication and its subsidiaries provide a range of products and services in the maritime sector. Primarily, it serves the oil and gas producers in the Gulf of Mexico by manufacturing highly specialized platforms and support vessels. Furthermore, the company offers maintenance services both in-house and offshore at existing client sites. With its subsidiaries, Gulf Island operates in a wide spectrum of the offshore construction business. Dolphin Steel Sales, for example, produces and sells steel to external customers as well as its parent company. This relationship serves as evidence of Gulf Island's vertically integrated business model. Gulf Island Fabrication operates in the offshore oil field services industry, primarily constructing specialized platforms for oil and natural gas producers. The oil and natural gas industry is broken down into 3 major sectors: upstream, midstream, and downstream. The company operates in the upstream sector, which is comprised of exploration and production companies and a supporting subsection known as oil field services. We will now discuss the threat of entry into this industry. The threat of entry into the offshore platform fabrication market is fairly low, especially in a low-priced commodity environment. The construction of offshore platforms requires highly specialized workers and established expertise. Additionally, the fabrication of offshore platforms requires a tremendous amount of raw materials, space to construct and store finished products, an enormous amount of initial capital. Gulf Island Fabrication focuses on specialized business segments, which would be extremely difficult for a new entrant in the market to duplicate. These business segments have been built over time, either through natural growth or acquisitions, and may be unavailable to new entrants in the market. The construction of smaller, shallow water platforms are easier to design and transport. However, shallow water Gulf of Mexico activity is continuing to decrease due to low crude oil and natural gas prices. Additionally, Gulf Island and its competitors have an established client base from reputable companies. A new entrant into this market would have trouble obtaining market share or competitive growth. There are many barriers to entry, and therefore, minimal threat to entry exists in the specialized offshore fabrication industry in the Gulf of Mexico. Here are some key financial metrics to help you get a better understanding of Gulf Island's financial status. The company has a market capitalization of nearly $128 million, an enterprise value of $81.5 million, a price-to-earnings ratio of 33.7, a dividend yield of 4.56%, and a return on equity of 5.42%. As of the end of March, Gulf Island's shares were trading around $8. Gulf Island Fabrication operates in an industry that is predominantly controlled by private firms. Due to the lack of available data on these privately held peer companies, we selected companies which are larger and are located in different geographic areas. These publicly traded companies offer similar products and services to those of Gulf Island Fabrication. Our first company, McDermott International, is a manufacturing and construction company that provides its clients with engineering, procurement, and installation services for offshore and subsea field projects. As its name would suggest, McDermott operates on a global scale and is in the process of expanding its business operations outside of the U.S. Its key areas outside the Gulf of Mexico are the Middle East, Caspian Sea, and Pacific Rim. McDermott International has a market capitalization of $638 million and a trailing 12-month revenue of $3.2 billion. Our next peer company is Chicago Bridge & Iron. Chicago Bridge & Iron Company was founded in 1889 in Chicago, Illinois. Chicago Bridge & Iron first started off as a bridge design and construction company, but switched its focus to the oil and gas industry in the early 20th century. This company's customers include Chevron, Chevron Phillips, ConocoPhillips, Dow, ExxonMobil, and Shell. In addition, they've also worked with the national oil companies of Dubai and China. Currently, Chicago Bridge & Iron has approximately 54,000 employees and a market capitalization of almost $4 billion. Technip, Gulf Island's final peer in this analysis, concentrates on project management, engineering, and construction for the energy industry. Technip was established in 1958 in Paris, France, with a workforce of 100 people. Today, Technip employs over 38,000. It has a market capitalization of $5.5 billion and does the bulk of its work in Europe, Russia, and Central Asia. However, it presently has $3.9 billion in backlog in the Americas. Additionally, in the third quarter of 2015, Technip was awarded 2 contracts in the Gulf of Mexico for subsea production tiebacks to floating production, storage, and offloading vessels. I will now explain some of the greatest risks that impact the financial performance of Gulf Island. The company is heavily dependent on its customers' capital expenditure plans. In turn, these companies will only increase their capital expenditures if their drilling programs are economic at current oil prices. As a result, Gulf Island is also exposed to volatile changes in oil prices. When rig counts decrease in the Gulf, the company has significantly less construction contracts, which are the foundation of their revenue stream. A company's backlog is a record of future contracted labor. Backlog risks for the company include cancellation, suspension, or reduction in scope of contract. A customer may also delay the execution of a project. Customers are, however, required to pay for the work performed and the materials purchased through the date of termination. Depending on the size of the project, revenue, net income, and cash flow may be decreased by a customer's alteration of its contract with Gulf Island. Weather and seasonality also pose risks for Gulf Island. The company states that its work activity generally declines in the winter months. This is due to a drop in temperatures, an increase in rain, and the decrease of daylight hours. In addition, the company's clients generally request completion of the projects in the summertime. The summer months do bring increased risk of hurricanes and tropical storms. The Gulf of Mexico and Gulf Coast are heavily affected by such weather events. These events also delay completion or installation of Gulf Island's projects. On the contrary, such storms also damage existing platforms, which require services of companies like Gulf Island, generating additional maintenance revenue. The oil and gas industry faces incredible risk from a regulatory standpoint. In the wake of events like the Macondo Deepwater Horizon oil spill, the federal government dramatically heightened regulatory controls to prevent future catastrophes from occurring. In particular, the Jones Act and the Sarbanes-Oxley Act increased the financial and time costs of day-to-day operations. These controls have a profound effect on the ability of oil and gas companies to operate at efficient levels in the deepwater Gulf of Mexico. In turn, this puts a strain on service providers like Gulf Island Fabrication. However, it is important to note that an increase in minor regulations like retrofitting and updating can actually provide additional work for the company. As of February 12, 2016, Gulf Island Fabrication has 14,600,000 shares of common stock outstanding, with 83% of these shares owned by institutional investors. As detailed in the table, Most funds investing in Gulf Island are index, core value, and growth at reasonable price funds. These shares outstanding and the position of these funds have not changed much over the past year. However, the number of investors has increased in index funds from 98 to 139, in core value funds from 24 to 45, and growth at reasonable price funds from 27 to 34. We give Gulf Island Fabrication Incorporated a rating of market underperform with a 12-month target stock price of $8. Our conclusion is the result of developing a forecasting model through 2018 using multiple regressions on what we identified as driving factors that accounted for almost 95% of the company's recently stated revenues. Some of these factors include offshore Gulf of Mexico rig count, oil prices, revenue data, and contract backlog data as reported by Gulf Island. Beyond 2018, we used a conservative average growth rate to predict revenues. After building out our regression model, we determined our 12-month future stock price using a price-to-book value ratio. We felt this portrayed the most accurate picture of Gulf Island's current financial situation. Our other options, such as a discounted cash flow valuation, in our opinion, ignore significant events such as recent acquisitions, as well as the fact that the company has negative revenue for the trailing 12 months. Here's a visual representation of our forecasted model, including our 12-month target price of $8. We have considered other trends and factors which would otherwise be excluded in our regression model. One trend that we believe could impact Gulf Island share price in a negative way is the number of oil rigs and associated jackets for offshore Gulf of Mexico that are currently in cold storage. These structures will in many cases still be usable when oil prices rebound, and are likely to impact and lag the anticipated revenue increases that may occur with a rebound in crude oil and natural gas prices. Additionally, exploration activity on the Gulf of Mexico shelf, where a majority of Gulf Island's products are employed, will be some of the last areas to see return to activity. In conclusion, our team of analysts generated a 12-month target price of $8 using regression and growth rate financial modeling and forecasting. This target price corresponds to an investor rating of market underperform. On behalf of my entire team, thank you for taking the time to listen to this presentation.